Okay, so if you've ever seen a financial chart, this is what they look like. I know there's a lot of stuff on the actual screen, but I will make it simple or a little bit easier to understand. To do that, I'm going to start off with the Dow Industrial Average, just because it's going to be the easiest one to demonstrate or illustrate what I'm trying to show you. Now, the easiest way to go ahead and show you this is going to be showing you how the math actually works in this. So Dr. Elliot Wave was a great mathematician back in the Great Depression era. His theory was that when a price is going to move, it's going to move in 5 waves, and it's going to be 3 up and 2 down. To measure those waves, we have to do the math, and for that part, I'm going to show you how the actual math works. Now, uh, if you ever heard of pi, there is another equation called the Fibonacci equation, and it's very similar. How pi always infinitely sums, so does the Fibonacci equation. To give you an example, 1 plus 1 is 2. What comes after 1? 2. And 1 plus 2 is 3. What comes after 2? 3. And that number just keeps going on forever. Now, if we take the 100 level to 0, so essentially from peak to valley, or 100 to 0, I'm going to zoom in real quick here to make sure I got this on the correct point, and I do. And then I'm going to go ahead and just check the bottom one as well. But essentially, if we move from our 100 to our 0, then that's going to show us in the future what price is going to do, where it's going to run into levels of resistance. And that's exactly what it does. So you'll notice that sure enough, even though that was drawn or mapped out 100 years ago, or nearly 100 years ago, every single time that we get to these lines, we face great resistance, or they act as a great level of support. So as we go up through this, this is going to be your ceilings of resistance, and as we go down, these are going to be your levels of support. And so you're not really supposed to measure 100 years ago, so I'm going to actually do it the correct way. And the correct way is I'm going to go ahead and measure what it would be at the current time. And so at the current time, and I'll start back in 2007. If we go to 2007, a great crash of 2008, sure enough, those lines get even closer. And if we look at the most recent crash, which was 2020 and COVID, those lines get even closer, and it maps them out perfectly where you're going to run into issues. So if we go and we measure again back of the Great Depression here, and I'm going to zoom in one more time just to make sure I got that correct. I do on that one, and zoom in one more time there, and off by 1. Even though it was 100 years ago, you couldn't put it any closer to the orange line if you tried. And the reason why it came in so accurate 100 years ago is because the math is actually correct. And if we do it again off the most recent one, and this is back in 2020, you couldn't put it there any closer if you tried. And that's the whole point. What we're going to do is add a couple other indicators onto the chart to help us get to our end goal here. And we're going to start off with the relative strength index, and then we're going to go for divergence and convergence. Now, if you do not know what these are, I'll explain it real quick in just a couple one-liners. Hopefully make this nice and simple. What the divergence and convergence is, which is going to be our bottom indicator, is going to show us essentially what the momentum of the actual asset is. So as the lines are going upwards, well, that's going to be positive momentum. As it's going down, that's going to be negative momentum. Going to the relative strength index, this is going to show us essentially the price confidence of the actual asset. So as it goes up, price confidence is high. This is usually when it's overbought. As it goes down to the lower end, this is going to usually be where there's no confidence in it. There's more fear. There's also fear of missing out and getting in at the right price to buy. And essentially, this is going to be where it's usually oversold. So overbought, oversold. Now, we want to use all three of these in conjunction, and the reason why is we want to go ahead and just essentially do deductive reasoning. If you have a 2 out of 3 chance of winning, well, chances are better than not. If you have a 1 out of 3 chance of winning, or only 33%, then chances are it's going to be a high risk to the loss. Okay, so now let's combine this all together and show you kind of what it means. So these lines that are on here obviously been there or been placed there for a reason. Now the ones that you see that are much thicker than the others, they are thicker because they are a more severe ceiling of resistance, or a heavier weighted, meaning that the price action has hit those lines or points in time a lot, or consistently and constantly, pretty much throughout its history. Now, let's go into the triangle, and then we're going to wrap it up here. Essentially what's going to happen. The triangle, oops, that was a terrible example. The triangle is this big white two lines, and the bottom down here, or essentially where there is no white line, is going to be the vortex of the triangle. Now, what the vortex is, it is the measurement of, that's what I want, it is the measurement of how wide that actual highest point was and what that lowest point was. Now, what you do to make this triangle is you take the two highest points, so this is number 1, this is number 2, and then you let the line go infinitely in the same direction, and that's going to be your top. Same thing on the bottom, lowest point 1, lowest point 2. Again, let it run as far as it can infinitely on the bottom. And then it gets you into your triangle, and essentially this is what's going to play out, and we're going to keep on doing this until we get to the very end. Now, the very end of this is essentially at the end of September. Well, that would make sense. The reason it makes sense is that your end of the year tax return is due at 12/31, so is mine, but for the federal government, it is at the end of September. That's when the balance sheet essentially resets and money policy starts to change. So they have to make it to the end of September, and that's essentially right when that timeline plays out. So what's the whole point, and what are you supposed to do with this information? Well, what it tells us is that we are getting to the near end to where we're going to see a major shift in interest rates. Now, the timeline plays out to where if it goes to the downside or rates get worse, we should see that actually all happen at the end of July. If it goes to the good side or the upside, then that should probably be towards the end of September. And so chances are it's going to get worse before it gets better, as it always does. So if you are floating an interest rate right now, this is not the time to float the interest rate. In fact, today was the highest price we've been at, and we're at the very top of that triangle of where we've been bouncing back and forth. So we can see for the next couple of days, we know rates are going to get worse. It's highly unlikely for it to go ahead and break the top of the triangle based off of what it's been doing. That triangle measures all the way from November of 2022 to all of 23, and then all of 24 currently. So because it's been running so long, that would tell us it's very strong. The trend is your friend. The trend has been on to the downside for much longer than it has been to the upside since rates have started going up. Probability is rates are going to get better really soon. The point is that if you have an escrow and you're less than 21 days of closing, lock your rate before it gets worse. As far as rates getting better, if you have an escrow that's at the end of August or in September, you can probably float. You can get away with it, and rates might get better by that point, or we might break out to the upside at that point. But this is not the time to float. This is the time to lock your interest rate, and we'll see what happens next. As rates change and anything major develops, I'll send out another video. All right, guys, talk to you later.